Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And over the last couple of weeks, we've been exploring different strategies that might assist a trader in protecting stock profits. Well, today we're going to be talking about protecting those profits using something known as a collar strategy. We're going to be explaining the strategy and demonstrating it, weighing the pros and the cons, a lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names, as always. I even see some new ones, so great to see you. But hello there, Kevin and Richard, Jay Richardson, Willie, the Wire Rabbit, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, as a matter of fact, I saw somebody chatting in saying they've been watching my series of 8 lessons on getting started with options, but they're just making it here in the live stream for the first time. Well, welcome. Great to have you. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to consume these webcasts, but also be aware that you're invited to join us in this live discussion. If you'd like to be here, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let everybody know that Brent Moores is joining us in the chats on YouTube. Brent's going to be assisting me with any questions that I can't get to just during the flow of the presentation that come in through that YouTube chat. Brent and I have been working together now for more than 2 decades. Brent's a fabulous coach, lots of experience. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there from Schwab on X. You can follow Brent there at Brent Moores CS. You can follow me on X at Cameron May CS. But also, I want to let you know, if you don't have an X account, you can also now follow me on LinkedIn. So just look for Cameron May on LinkedIn. Look for the guy in a suit in front of a Scottish castle. There's the account. Give me a follow. Whether you're using X or LinkedIn, there's no cost to give us a follow, and it's the best place to connect with us in between these live streams. But let's get into this discussion. Of course, what we're going to be discussing is risk management, but risk still exists. There's always risk. If we're engaging in a pursuit that carries the potential for reward, we also need to be aware that there's the potential for risk. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The covered call strategy can limit the upside potential of the underlying stock position. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so with that important information disclosed, let's set the agenda for what we're going to be talking about today. So today, we are talking about protecting stock profits using an option strategy known as a collar. It's going to be a familiar strategy to some of you. I'm going to try to give you a new view of that strategy. If it is, it's going to be a brand new strategy for others. So I'm going to go to a pace that everybody can follow, hopefully. So what we're going to do is take a look at an example stock in our paper money portfolio that's really been going up, put ourselves in the shoes of a trader who just has the interest of protecting themselves from risk for a period of time. And then we're going to plan and place an example collar strategy on that example stock, weighing the pros and the cons of the strategy as we do that. And then we'll plan it, we'll place the trade that we planned. All right. So the Wire Rabbit says, does it have to be a Scottish castle? Just in this case, yes, it happens to be a Scottish castle. I took the picture myself in Scotland, so yep. In any case, let's go right to the thinkorswim desktop platform. And today I wanted to talk about what's been going on with Apple. Let's put ourselves in the shoes of a shareholder, owns 100 shares of the stock. Maybe they purchased down around 207, 208. That might have been anywhere back through this range. All right, lots of people trading Apple back in that time. But if you look at what's happened since then, really started to climb, just had some positive news that drove the stock up to maybe what some traders might consider a short-term extreme high. Doesn't mean that the stock can't go higher, but as our trader here is looking at their 100 shares, bought these for about $208. They're worth about $264 right now. We've just had a short-term spike in trading activity, and what's also right around the corner that could really throw a wrench into the works, maybe expose a lot of this profit to loss. We have an earnings announcement coming right around the corner. Doesn't mean the earnings are going to go poorly, but our trader just has no insight into this. As a matter of fact, on both X and on LinkedIn, I posed a question to my followers. What goes through your mind when you see a big spike in trading like this on a stock like Apple? It'll be interesting to see what they have to offer, have some back and forth with them. But in any case, let's just say that our trader, they're just satisfied for the moment. They don't care whether they make additional money as long as they don't lose a lot of money. So they're thinking hedge, they're thinking protection, they're thinking, I don't think this is the right phrase for this, but for some people, they call it insurance. It's not insurance. Insurance and hedging with options, insurance on, let's say, a car or a house versus hedging with options, very different beasts. Hedging with options can come at a significantly higher cost in one way or another than paying, let's say, a relatively marginal insurance premium to protect some asset. Probably doesn't need protection, or at least for the month or whatever of the premium. Anyway, I'm not saying don't buy insurance. I'm saying it's just unlikely that our car is going to get in an accident this month or our house is going to burn down. But our stock could certainly go down. Okay. In any case, so we're going to collar this one. So here's how a collar works. A collar consists of two options positions. We're going to buy a protected put, which we discussed last week. And if you missed that presentation, here's what I suggest you do. If you are new to following these videos, you're just watching our webcast for the first time, make sure you go down and click on the subscribe button. That doesn't cost anything. It only takes a second. But our Trader Talks Schwab Coaching webcast channel on YouTube is where we house our previous webcasts. So you can look up Trader Talks Schwab Coaching webcasts, go to playlists right here. Of course, you can join the live streams, but you can also go to playlists, and then you can go down through our series of webcasts and find the one that you're interested in. So for example, this one, Getting Started with Options, it's more toward the bottom of all of these different playlists. There's Getting Started with Options. Barb's face is on the thumbnail because she covered for me recently. But if I click on View Full Playlist, I can see previous webcasts in this series, including last week where we talked about hedging stock trades by buying put options. This was a beginner's guide to something known as a protective put. Now, one thing that we need to talk about here, though, when we buy a protective put, that can be a comparatively expensive investment because unlike insurance on a car or insurance on a house, when we buy a protective put, we're hedging against something that's actually quite likely. House probably isn't going to burn down this month. The car is probably not going to be in an accident, just going on probabilities. But a stock could go down quite easily and does it on a pretty regular basis. So we're trying to hedge against that. And it could be even worse. So even worse with an earnings announcement. So could be pretty pricey to buy some protection on this stock at this particular moment. Let's say that our trader wanted a hedge. The hedge is it might be because they think maybe in the short term we spiked up, and just on pure technical analysis, they might think that might be time for some profit taking anyway for some traders out there. Now, compound that with this earnings announcement that could just spike us in the wrong direction. And in any event, even if the earnings goes well, you know how sometimes it's just not received well, and we might get big sell-offs in the subsequent weeks. Let's say that through November 21st, the trader just feels like they'd rather not have to subject themselves to all this volatility. Now, what they could do is just sell the stock. Could do that. But let's say they don't want to sell the stock. Instead, they'd rather hedge it. So they think, let's go buy a protected put. That's the first element of this trade. Let's close out all this information from a previous webcast. Let's put on a new example trade, which is going to be collar. So it begins with stock ownership. We have 100 shares of stock in this case. Then we add a protective put. This out of the way so you can see what we're talking about. So if we go to the trade tab, and let's say we're thinking of buying a put that takes us out through at least November 21st, gets us through that earnings announcement, maybe through any subsequent volatility, or at least through the bulk of the subsequent volatility. just trying to get through the choppy part. So we go to the trade tab, we go to the 21st of November, and we look at with the stock trading around 264. What if we buy like the 260 put? Looks like that might cost us, $6.75 per share to $6.85 per share on 100 shares. Let's say we're able to get that for $6.80. We buy the 21st of November 260 put. That looks like it might cost us $6.80. Or in other words, our premium for the month for protection is $680. So what do we get for that premium? We're paying $680, but at least we know for the next 31 days through the 21st of November, that trader would then have the right to sell their shares for $260 if they needed to. If the earnings went just terribly, or even if just traders started selling off because they just made a bunch of money, let's say the stock just collapses. Well, at least we know that we can sell those shares for $260 if we need to. Cost for that, though, is $680. That's significant. To some, they might say that's substantial. To others, they might say unaffordable. In any case, for that reason, some traders will turn to, instead of just a protected put, they'll add a second option here, turn it into what's known as a caller. And actually, that can serve to reduce the cost, maybe eliminate the cost of this protection, at least the out-of-pocket expense. So this is how this works. In addition to the protective put, buying the protective put, we sell, maybe I'll do this too. Let me put in the word buy here, just to emphasize. We're buying a protected put. We're going to sell a covered call, essentially to pay for, to compensate for, to finance purchase of the protected put. So let's go back to our trade tab. And with our protective put, we purchased a put that was about, it's about $4 in the money. It's the first strike in the money in this example. Let's go one strike out of the money. How about we go to the 270? Let's go two strikes. No, yeah, two strikes. There is a 267.5. I don't know. Maybe we do that one. Yeah, why not? Let's do that 267.5 call. Let's see. Nah, I'm going to go to the 270. With prices fluctuating, sometimes I'll change my mind. But let's say we sell that covered call. I already said buy up here. Okay, I'm being redundant. Let's get rid of the sell here. So we're going to sell, in this case, the 21st of November, staying with the same expiration. We're going to sell, same month, but a different strike, the 270 call. And it looks like we might be able to pull in about 615 to 620. Let's be a little bit generous here. Let's say that we're able to sell this for $6.20. So that actually, instead of taking money out of the account, is actually contributing credit to the account of $620. What did that just do? Tempted here. Sorry. I'm going to have to do this just because I'm thinking of the way that I want to sort of package this video after the webcast is over. I'm going to change this just a little bit. Let's do that 267.5 call. I think it's going to really drive home a point that I want to make anyway. So the 267.5 call, maybe we can get 715 to 720. Let's call it 720. All right. But that retrieves a credit of 720. So we have a debit up here, spent 670. We have a credit from selling the covered call. I'm sorry, but didn't that just eliminate the cost conceptually of this trade, of this protection? We still have the right to sell the shares for 260 if we need to. And we've sold a call to help finance or pay for, compensate us for that purchase. As a matter of fact, with this one, instead of coming out of pocket $40 or $680, this would be done at a net credit $40. Essentially, no cost. All right. Oh, awesome. We just got some free, let's throw the word insurance in here. I don't think that's an appropriate term, but I just hear it used so frequently. I try to address that. We got some free protection, some free hedge, right? Free. No, it's not free. But let's talk about why this is known as a collar, the pros and the cons, and I want to emphasize why it's certainly not free, even though we're getting even a credit. So in this case, I'm looking through the chats just to make sure I'm not missing anything. I don't think that I am. But let me know if I miss a question. Feel free to repost it. I'll try to get it addressed. I know that Brent's doing a great job too. But in any case, this is our collar. And it's referred to as a collar. Think about this. I think of sort of old-timey police movies, back in the day when they had the black and whites with the people chasing each other in fast motion. You have the policeman chasing the bad guy. And if you grab the bad guy, sometimes literally by the collar, you use this phrase, we collared the criminal. It might also think that we've sort of gotten our hands around it, right? Well, that's kind of what this trade is doing with our stock. Because at one moment, if we enter this trade, we've purchased the right to sell our shares for $260, which can be awesome. If the stock collapses in value, great. We have a contract that gives us the right to sell those shares at $260. So we limited the downside. But at the same time, we entered into a covered call. And if you watch my regular webcast series on covered calls and short puts, you know that a covered call caps the upside potential of the stock. So yes, with this collar, we have the right to sell for $260, but we also have an obligation to sell if the stock rockets upward. We have an obligation to potentially have to sell our shares at $267.5. So with the stock around $263.5, there's not a lot of upside wiggle room. What we've effectively done here, and by the way, this is where I think of it, this is a collar. If we think we're getting our hands on around that criminal, controlling them, yeah. Well, this is kind of like we have our hands around the downside of our trade, but also the upside of the trade. We have collared the stock's ability to lose money, but also to make money. We've put it in chains, basically, for a little bit. So that's the way that I think of a collar. But I really do want to emphasize that it's not free. What we've actually done here, instead of just spending $680, well, we've eliminated that cost. But the trade-off is that we've also surrendered the upside potential of the stock above $267.5. So Ambrose asks a great question. What are the criteria for the selection of the strikes? So let's address two questions. I'm going to take yours and expand on it. What about time frame and strike selection? Well, time frame, fairly straightforward. The trader, this is typically a strategy that's put on very strategically. Oh, that's interesting. It's a strategy that's applied strategically, but typically this is a trade when the trader is so concerned about the downside that they don't mind limiting the upside for a period of time. So whatever that period of time is, in this case, it's just getting through earnings, maybe past this point where we've really hit a peak and the trader just wants to maybe try to sort of take their stock out of the exposure, at least conceptually, to volatility through the 21st of November. So we pick the expiration that gets us through whatever volatile period that we're concerned about. Recognizing for that period of time, limited downside, yes, but also limited upside. So that's expiration selection. What about strike selection? What you may notice here is we have not much wiggle room to the downside, so not much downside exposure. That came at a pretty heavy cost. We also don't have much upside potential on the trade. That was to get a pretty heavy premium collected. So if we have our strikes close to at the money, the trader has to be okay with not much wiggle room. Considerable protection, but not much wiggle room for the stock to make or lose money. Now, if the trader would prefer some more upside, they may have to move the strikes further out of the money, maybe even move the put further out of the money. If we go further out of the money, it allows more wiggle room for the stock, but it provides less protection. All right. So is there a right or a wrong answer there? No, it just comes down to the preferences of the trader. Closer to at the money if we don't need wiggle room and we prefer stronger protection. Further out of the money if we prefer more wiggle room, take on more risk, but just a lower degree of protection. Tammy says, will this be a way to profit from a range-bound stock? Interesting question there, Tammy. It's not. This is actually not a strategy that's applied in an effort to make a profit. It's a strategy that's applied in an effort to protect a profit. Very different. So glad you asked that question. So let's really break this one down. As a matter of fact, let's just go ahead. I'm going to draw this on our chart, but how about we go analyze this trade? I got a lot of fans of the risk profile tool on thinkorswim, so I'm going to put this on and analyze it. There's our earnings announcement. So what we're considering doing here is we're thinking of buying the 260 put. That's about right there. Let's move this down to about 260. That's close enough, 259.97. Actually, I can just right click on this. Let's edit its properties and just say 260. That represents the put that we're buying, but our call that we are selling is up here at 267.5. So let's just get that as close as we can. Let's edit that and say 267.5. There we go. So there's our stock. It's very much just sort of pinned in, because if the stock goes down, the trader can sell shares for 260, not much downside. If the stock goes up, they may be required to sell those shares to somebody else. Not much upside potential. So you might just think, well, Cameron, isn't this inevitably going to result in the sale of the stock? No, not necessarily. The Wow Rabbit says that tool baffles me. Okay, I'll try to make sense of it. What other question do we have? Jazzfish says, what about sacrificing some credit or even having a small debit in order to keep the put but expand the upside? That's another possibility, right? We could have spent the 680 for the put and then just sold a less expensive call further out of the money, giving it more upside potential, which just means we're maybe chipping away at the cost of the put, but not entirely eliminating it. Lots of different ways this caller might be customized or tailored to the trader's preferences. Yep, great question. So which is the right answer? There is no right or wrong answer. It just depends on a trader's preference. But what is important is to understand how the strategy works. Then we can start to play around with the variables of it. All right. But let's go put this trade on. So the first thing I want to do, let's go to the Analyze tab. And for those that are not familiar with this, let's go to Add a Simulated Trade here. Go back to our risk profile. Oh, this is what this is doing right now. Is it is analyzing how a stock might do. Let me explain how this thing works. Okay. So when we load up the risk profile, it's really just a grid. It's just a grid of example stock prices. So our stock right now is at about 263 and change. That's this right here. Okay. And then what it's showing us is a profit or loss. How about we do this? I'm going to take off my Apple position. And let's add a simulated trade. Let's go to that stock position. Let's add like just an example, 100 shares of stock. Okay. Go to our risk profile. Let's assume that we just now purchased the stock, paid $263 for it. Well, 263 is where we are right now. We're at zero profit. So over here, it's showing us potential profit and potential loss. Well, if the stock starts to fall from 263 to 260 or 250 or 240, our profits fall. Break even down below. Maybe we fall down to $5,000 if we fall far enough on the stock. On the other hand, if price starts to rise above 263.5, maybe we're at 270, 280, 290, well, profits are accumulating. But when we're staring in the face of a giant event like an earnings announcement or a big spike in price, we're concerned that it might fall. Well, this becomes the real concern, right? So let's add a collar here. Let's collar the profit and loss potential of this trade. So I'm going to go back here to add simulated trades. So we're just simulating what might happen. And let's go to the 260 puts, and I'm going to buy one of those. So let's click on the ask price and buy just one put. We have 100 shares, so let's just buy one put. And then at the same time, we're going to go to the 267.5 call we were thinking of selling, and we're going to click on the bid price for that. And let's just make sure that we're selling just one of those. So this total 100 shares of stock, a long put and a short call, this is known as a caller position, right? So now if I go to my risk profile, let's see what it looks like. Very interesting. This yellow line is now showing us how this net trade might work out. The stock is right here, basically at no profit, no loss. If it starts to go up, that's great for our stock position. We own 100 shares. If it goes up 264, 265, 266, awesome. If it goes up above 267, though, notice what happens. Our profits stop growing because someone else has the right to buy those shares at 267.5. We don't participate in that additional growth. Someone else can say, you know what, Cameron, give me those shares. Is this becoming less baffling? Wire rabbit? Excellent. All right. So here we are. Let's just roll back to square one again. We own the shares. We have an obligation potentially to sell at 267.5. That would put a cap on our profit. Well, what if we start falling instead? Oh no, we've fallen from 263 to 262 to 261. We are losing money, except down there at 260, we have the right to sell. If it collapses, if it goes 250 or 240 or 230, it doesn't matter because we have the right to sell for 260. So our losses are minimized. They're capped right there. So you can see the collar effect here. This is where the stock is. We've got our hand around potential profits. We have our hand around potential losses. We have collared this thing for a period of time. What happens after the 21st of November if our stock hasn't really moved? Well, our call expires worthless, and we keep $720. Our put expires worthless. We lose $680. And hey, what do you know? We come out of this $40 ahead just on the option side of things. And then there's no collar around this anymore, and the stock will just do what the stock does. So Hello Prasad says, where's the simulated trading application? The Schwab website outside, or where can you download? Oh, thank you. Yeah, great question. Yeah, this is known as thinkorswim. Well, I've returned a phrase, think, then swim, right? Thinkorswim can be downloaded free of charge from within your Schwab online account. Here's where you would go. Well, I'd have to go log into Schwab. I'm not going to do that. Anyway, go to the Schwab online account, log in, and just click on the trade tab, and you'll see it right there in the menu that pops down. Look for thinkorswim, click on that. There'll be a big blue button. Click on the blue button, it'll guide you through the download process. It doesn't cost anything to download thinkorswim, but thinkorswim does give you access to a practice trading environment known as paper money or simulated trading. That's what we're doing right now. But we can also access our real accounts, our real balances, and trade those. Okay. So there is our collar. So I want to put a collar in play here. But then before we're done, I want to talk about the objective of this trader is not necessarily to sell the stock. If they just wanted to sell the stock, why don't they just sell stock on day one and not put the collar on in the first place? Yeah, they just want to protect the stock for a period of time. But let's go place the trade. Let's go to our trade tab. Actually, let me go back here to Analyze tab. If you've started to analyze things, you want to unclutter this tool, just click the little X's down here and get rid of those positions. There you go. Anyway, but let's go to the trade tab. So we're in the account. This is in our example margin account. So we just make sure that we add the collar in the same, or enter into the contracts in the same account where the shares are held. That creates the collar. Go to our trade tab. Go to the month where we intend to put on the collar, and then just hold down the control key on the keyboard, start clicking. The control key allows us to sort of stack up different legs of options trades. So I'm going to hold down the control key on my keyboard, and I'm going to click on the ask price for the 260 put, and let's just minimize that for a moment. And we're going to go back up here while holding down the control key. And you'll notice these hotkey numbers start showing up. That's just a sign that I'm holding down my control key. Watch this. I'm not holding down the control key. Now I am. I'm not. Now I am. Okay, so while holding that control key down, I go to the bid price for the call that I want to sell. Ooh, look at this. This is interesting. $7 here, $7 there. That could be just the perfect example. Look at that. How much might this cost us? How much of a credit might we get? None. Right now, we just happen to be, let's just say that we're willing to get into this for 0 credit. Just want to do it for free. It's not free. We're capping the upside of our stock position. Anyway, let's click confirm and send. The one thing that we want to consider here, before we do that, dial this just down to 1 contract for 100 shares. Click confirm and send. Going to call this a combo because that's all it is right now. When we pair it up with the stock position, it becomes a caller basically. But we're looking to buy the 260 put, sell the 267.5 call. Maybe there's no cost, but there is a commission to be paid on both those. So maybe, okay, $1.30, literally $1.30. Let's see if we can get that done. Sold it. Oh, interesting. Okay. So we actually got a 25-cent credit for that. Yep, got a 25-cent credit. That's $25 minus $1.30. So great, we got a credit of about $23.70. But in any case, at this point, we've put that collar on, and if the stock goes up, we might have to sell. If the stock falls down, we can choose to sell at 260. But most of the time, a trader is putting this collar on, not with the intention of ultimately selling, but actually just to hedge the position. And it actually is quite a good hedge, even if we don't wind up selling the stock. Let me explain that. I hope you don't mind going just a little bit deeper into the weeds. Let's go back to our trade tab here. And I want to talk about delta for just a moment, because when trading callers, the trader really doesn't give much attention to things like time decay or volatility changes, or even what's happening with interest rates. The other things that can change the value of options don't really play much of a role here, because we bought an option and we sold an option. Bought an option, time decay working against it. Sold an option, time decay working for it. That's kind of a wash. Bought an option, rising volatility helps it. Sold an option, rising volatility hurts it. That's kind of a wash. So what's the real driver here? Let's look at how much protection this is actually offering on our stock. You might think, well, Cameron, yeah, we can sell stock. We get it. That's not the objective here most of the time. Instead, it's just hedge. Let's see how much of a hedge we got. I want to look at this 260 put. We talked about protected puts last week. If the stock goes down $1, how much did the put actually hedge? Stock goes down $1, we lost $1 in unrealized losses on our stock. That's the way it works. But our put has grown by 41 cents in value. It's a 41% hedge. That's what our delta is telling us. A $1 delta starts with D, so does dollar. A $1 drop in the value of the stock is partially offset by a 41-cent increase in the value of the put. We could then go sell the put for 41 cents more than we paid for it, as an example. Conceptually, obviously, liquidity can play a role, that sort of a thing. But at the same time, we also sold a call. When the stock falls in value, calls lose value. That call that we sold, we could probably buy back for about 45 cents less. Hey, we made 41 cents on the put. We made 45 cents on the call. That's 86 cents on the dollar protection delivered by this caller. Is that a pretty good hedge? Eliminating 86% of, or at least conceptually eliminating 86% of that very first dollar of downside risk. That's a pretty good hedge that we didn't actually pay for. We got a credit to do this. Again, the trader just needs to remember we didn't pay anything for it, except we did surrender the upside potential on the stock above 267.5. Eric says, how do you protect against a call exercise if you're sitting on a big capital gain? Eric, you don't. That's a good question. Yep. For some traders, they really, really, really don't want to sell the stock. Guess what? This includes a covered call. And when we enter into contracts where we promise someone else that they can buy our shares at any time for any reason, purely at their discretion, how much control do we have over that? Zing, we have zero. Yep. So this is not a strategy for someone who isn't at least aware and willing that they might have to sell their shares. Now, tax considerations aside, because I can't comment on that, would it be a disastrous outcome here? Let's suppose this trader went ahead with this caller and the stock went up and they had to sell the shares at 267.5 that they previously bought for 207.5. I don't know about your math, but mine says that's a $60 profit. Yeah. So it wouldn't be like a disastrous outcome. We'd probably be selling below what the shares would be worth at that moment. It would essentially be a forced profit-taking scenario. But yeah, this is not a strategy. Just like any covered call, a caller is not a strategy that the trader would want to probably even consider if they really, really, really don't want any exposure to having to sell the stock unless it's in their control. All right. But the point that I wanted to make here is the combined protection. We own the stock, which is a bullish position, dollar for dollar bullish position with the stock moving up. A caller is actually a combination of two bearish positions. We own a long put, that's bearish, and we sold a short call, that's also bearish. So if the stock behaves bearishly, the combination of those two bearish positions adds up to, in this case, 86 cents of protection on the very first dollar. There's actually very little risk exposure, even as the stock goes down before it gets down to 260. Worst case scenario with the math on this trade is if the stock falls below 260, yeah, we surrendered unrealized gains from 263 and change down to 260, about $3 worth of risk. Best case scenario is if the stock goes up, and go back to Eric's question, if we get called out, and we sold the stock for $267.5, having previously purchased it at 207. Randy says, can you roll a short call? Randy, rolling is yeah, it's certainly potentially possible. I'm not going to get into that or when a trader might choose to do that. We don't have the time, but is it possible? Yes. Okay. So, but guys, this is known as a caller. Now, if this is your first exposure to this, and by the way, what might the trader choose to do if the stock is falling? Stock is falling. Ouch. Owning the shares, that's not fun. But the two bearish positions that we have in place are helping at least 86%. The protection actually grows from 86 to closer to 100% the further the stock falls. Well, if they don't want to sell the shares and the stock is falling, what might they do? They might buy the call back, probably for much less than they sold it for, and they might sell the put, probably for more than they purchased it for. The combination of those two exits compensates for the fall on the stock, and that's the hedge. Okay, so we'll talk about that in maybe a future webcast, but this has been my introduction to protecting stock profits using a caller. So we've explained how the caller works. We've demonstrated how it's done. We've actually even planned and placed the trade. We analyzed it. We talked about the Greeks. That's a lot. I hope that this has been insightful, whether you're brand new to the strategy or even if you've had good experience with it. Maybe we've looked at it through a different lens. So I think hopefully there's something valuable here for just about everybody. And this is what we do in this webcast series. It's called Getting Started with Options. Sometimes we go a little bit deeper into kind of a multi-leg strategy, which is what we've done today. Other times we just stay straightforward with more of just maybe buying a call or buying a put. But I hope that you'll put this in your calendar to join me on a regular basis. You can join the live stream on Tuesdays at noon, or you can just watch the archive. Either one of those is great. But time for me to let you go. As you do, I want to give you a reminder of the educational resources that you have available to you from Schwab. Number one is that if this is your first viewing experience, you're first checking out our channel, welcome. It's great to have you here. But before you leave, make sure that you subscribe to the channel. Click on the subscribe button. It only takes a second. It doesn't cost anything. Channel name is Trader Talks Schwab Coaching Webcasts. And that's where you can go to find the playlists of our completed webcasts, our previous webcasts. You can join the live streams right here. Or if you want to learn, maybe you want someone else's perspective on callers, just type in got to make sure you get both L's in there. Let me just type in the word caller here. And what do you know? There's a range of our coaches talking about caller strategy defined, trading callers, how to use options for protection on stock trades, something I discussed about a year ago. You can go back and watch those previous webcasts. Another thing that I'm going to strongly recommend is if you have an account on X, you should be following your favorite Schwab presenters there. You can follow Brent on X at Brent Morris CS. You can follow me on X at Cameron May CS. Let me show you that. Here's my profile on X. There's my handle. Give us a follow. That doesn't cost anything. Here's that Scottish castle I was referencing. You'll find that here. Just make sure that you're using the correct name, looking at the right guy. Give me a follow. And if you reply to one of my posts here, I just reply right back to you. It allows for some nice interaction when the camera's not on and when we're not in a webcast. Now, another thing that's brand new, literally this is the second webcast I've ever discussed this, is you can now follow me on LinkedIn as well. I have a LinkedIn profile. For right now, let me go over to LinkedIn. There I am, slightly different pose. There's that castle in the background. So look for Cameron May on LinkedIn. Give me a follow. For right now, I'm posting pretty much the same thing on X and on LinkedIn, but I'm going to mix that up in the future. So if you want to be part of maybe a smaller, more intimate audience, or maybe you just don't have an account on X, give me a follow on LinkedIn. Doesn't cost anything. And if you reply to my posts here, I'll reply to you there as well. All right, everybody, that's going to do it. Thanks for joining me today. I definitely appreciate your attendance. I will look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.